Japanese candlesticks, one of the world's most popular charting techniques. Now, candlesticks have been around since the 17th century, so they've been around for quite a long time. Now, I've put together for you, and please download them at this point because they're not available at any other time or place. And I've given you 3 handouts. One will show you the number of candles and give you an explanation. And these are the most popular candlestick patterns. Then there's also a handout on the second level candlestick patterns, and also a list and an explanation of the top candlestick patterns. Because you don't have to memorize all these, but you should be familiar with them. So please click on the download button now and download them because you won't be able to get them at any other time. Now, each candlestick represents a data set for the complete price action during the selected time frame. So a candlestick gives you 4 important pieces of information right off the bat. They give you the open, the high, the low, and the close. So what we do to each candlestick, to make up each candlestick, is at the open of the time segment, we draw a line across. At the end of that time segment, regardless of what time frame we're using a 1-hour chart, it's the beginning of each hour and the end of each hour. If you're using a 5-hour chart, it's the beginning of the 5 hours and the end of the 5 hours. If you're using a 1-day chart, it's the beginning of the day and the end of the day. Because price doesn't never change. It's just your perspective of price. If you're looking at a 1-hour chart, it takes 5 candles to show you what happened in 5 hours. So if you're looking at a 30-day chart and a 1-day chart, it would take 30 of those 1-day candles would be included in that one big candle for the 30-day period. So once we draw the lines across, we put a dot at the highest level it got to and a dot at the lowest level it got to. We connect the dots to the lines, and these are called wicks or shadows, and then we connect the body of the candle or form the body of the candle by connecting the lines. If we step down from the open to the close, that is a bearish segment. If we stepped up from the open to the close, that's a bullish segment. Now, a lot of people get confused with the reds and the greens or the blacks and the whites. Back in the old days, like when I first started trading, we were hand charting. Very few people use candlesticks because they were time consuming. But for those that did, is when they would put all the dots under their chart, if it was a bullish time period, they just wouldn't color in the lines. They would just leave it white. If it was a bearish time segment, they'd use the side of their pencil and fill it in, and that would become the black candle. So today, white is synonymous with green. Red is synonymous with black. They're both bullish or bearish. But the fact is, today with computerized charts, you can use pink and green. You can use orange and purple. As long as you know which one's bullish and which one's bearish, doesn't matter. Okay, you can have your own color codes, your own symbols. So you'll find a lot, but red and green are what's the popular today. Now, once we put our lines or drawn our body, our candle, we have to understand that candlesticks aren't about all the reds and the greens. And this is where we get into trouble, because too many traders look at a candlestick chart and think that the more reds they see, the more bullish the price is, or the more green they see, the more bearish the price is. So when they see lots of red and green, look, we're all human beings. So we're affected by this psychology. You see lots of reds, you think the chart's trying to tell you, or the candlesticks are trying to tell you to trade it to go down. But that's the farthest from the truth. Because candlesticks are about the size and the shape of the candle, where it sits in relationship to the trend line, and how it sits in connection with the previous candle the current candle, and the candle after that. So what we're seeing right here on the gold chart is this is called a doji. This is a very well-known candle pattern where there's virtually no body and long wicks. We see it coming after 3 candles, but we also have a very strong uptrend. So that doji does tell you something, but you have to interpret it with that candlestick and the size and shape of that body. And it's a doji because the open and the close are virtually the same. And it doesn't really matter whether it's red or green. Okay. The fact remains, it doesn't when we're talking about candlesticks. So let's go back to my PowerPoint. And let's talk about these candles. So the first thing the candles tell us is a story about the bulls and the bears. And there's 6 standard interpretations. Okay. They tell us who was in control of the market during that time frame. Now, the only one that really counts are in 1 and 2. Because the other ones don't tell us that much. But in this case, in 1, we see that the price opened lower and closed near its top. That tells us the bulls were in control. Number 2 is the exact opposite. If you notice, we look at 3, 4, 5, and 6, we have very small bodies, okay, whether they're green or blue. Now we have wicks that shot all the way down or wicks that shot all the way up. That told us that somewhere in that time frame, somebody got a little burst of energy, but because the open and the close were almost the same, that nobody was really in control. But ultimately, we need to understand that battle of the bulls and the bears. Then we have to also, once we've understood the battle, we have to start looking for candles that tell us something. Because, price moves all day. It's making tons and tons of candles. Not every candle tells us something. Then there's certain candles that tell us more than other candles. One of the more popular ones is called a Marabuzu. Now, can you look at this candle and tell me what's different about the Marabuzu? If you notice, it has no wicks, no shadows. So what does it tell you, or what do you see when you see a green or bullish Marabuzu? Well, if you understood what I told you about when we were looking at the formation of a candle, the wicks are the highs and the low. Well, if there is no wicks, that tells us the price frame or the price action moved up from the very beginning of that segment, because we put the line across at the open. We never had a low, and price shot all the way up. And because we don't have a wick up above, it tells us what? That it closed at its very high. So it tells us from the second that that session opened to the second it closed that the bulls were in control. That's a very important thing to know, because if that segment hadn't closed, it would have continued up. So therefore, the next candle would be expected to be just as bullish, or that the bulls are dominating the market, or just the opposite when we see the red. Now, the fact is, we have a very specific candle that tells us something very specific, but now we have to look at where it appears in the trend. So if we get a bullish Marabuzu in the middle of sideways congestion or coming off of a downtrend, that tells us that current downtrend or that sideways congestion is over, and the asset's going to start moving into an uptrend. The reverse holds true. Remember, for candles, everything that holds true in one direction holds true in the opposite. So when we're coming off congestion and an uptrend, and the bearish Marubozu appears, we're moving into a very strong downtrend. Then we go to the ever popular doji, which I mentioned when we were looking at the charts. Now, what we see now, ideally, a proper doji is a simple cross like this, meaning that the open and the close were the same. Now, this was more definitive or fit better when the markets move slower and before we had Forex and CFD trading, because the stock market, lots of times you had stocks that didn't move at all during the day, and the stock market moves in bigger increments. So a penny or a quarter up is a big move, or a quarter down. So it was very common for the asset or stock to close where it opened. When we're trading in the Forex market, when we're using pips that are 4 decimals over to the right, the explanation is acceptable because the euro trading at 16123 and closing at 16124 is relatively the same. You know, it's 1/1000th of a point. So, but we can't change the way a chart is made. So the explanation of a doji means that the open and the close were relatively the same. And that tells us there's a huge amount of indecision in the markets, and basically the buyers and sellers are sitting on the sidelines. It has nothing to do with volume. It's only price movement. And a doji appears quite often during a trading period. So it's one of the things that you should be able to notice. Now, the relatives of a doji depends on the preceding trend and the preceding candlestick. After an advance or a long white candlestick, a doji signals that the buying pressure is starting to weaken. After a decline or a long black candlestick, a doji signals that selling pressure is starting to diminish. So what we're looking for is we need to see how that doji appears in conjunction with the trend and the previous and then post candle. Because like I said, dojis appear quite often. But when they do, when you use the 3-prong approach, they are very accurate. So before turning to the single and multiple candlestick patterns, there are a few guidelines we need to cover. So I'm going to run you a quick video that'll help you explain this more. And then we're going to go talk about the other types of more complex patterns.
The Japanese candlestick chart. Get to know the main chart patterns. You probably think that financial analysis is complicated, but it actually comes down to 2 simple things: reading charts and reading news. There are many types of charts, but Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks, or candles, lined one after another. Each candle gives you detailed information about the price movement within a specified time interval. In fact, Japanese candlesticks are the best way to visualize the ups and downs of a price so that you can spot potential opportunities to buy or sell. Let's take a more detailed look. Every candle consists of a body and 1 or 2 tails called shadows sticking out of it. The body indicates the range between the open and close price for a specific time frame, and the shadows represent the highest and lowest price levels reached for the set interval. Japanese candlestick charts are easy to read. A red candle shows that the price is going down, and a green one represents an increasing price. If you're looking at a 10-minute chart, each candle represents a 10-minute time interval. We see a green candle when the open price is lower than the close price. If the price closes lower than it opened, then the candle is red. As simple as that. What kind of signals does a candlestick chart provide? It's no surprise that candlestick charts are so popular. They're excellent for spotting market turning points. By looking at the patterns that candles create, you can often guess if a certain market is about to continue in its current direction or reverse it. Patterns that show that the market could change direction are called reversal patterns. They could be bearish, ones that indicate the change from an uptrend to a downtrend that should be perceived as a signal to sell. Or bullish, these show that a price that has been decreasing is likely to start going up and we should buy. Let's see the most popular candlestick patterns which encourage you to buy. Bullish engulfing. The bullish engulfing consists of a red candle followed by a bigger green one, which fully engulfs the red candle. The pattern is an indication for a market turning point. In simple words, it's likely that the market may start going up and you can buy. The indication is even stronger if the green candlestick engulfs 2 or 3 red candles. Hammer. The name of this candle is pretty much self-explanatory. You'll recognize the hammer by its short body, lower shadow that is about 2 or 3 times the length of the body, and a shorter upper shadow, or no shadow at all. The hammer is usually a clear indication of a declining price reversing its direction and starting to go up, so you can start buying. But just to be safe, you could always wait for additional confirmation. Such confirmation is a green candle closing above the open of the hammer, for example. Morning doji star. This pattern appears when there is a slight market movement and consists of 3 candles, a red one, followed by a doji, followed by a green candle closing beyond the middle of the first candle. If the green candle is longer than the red one, the signal is even more reliable. Spotting the morning doji star is a signal to buy. Some chart patterns that mean you can sell. Bearish engulfing. This pattern is the opposite of bullish engulfing. A green candle is completely engulfed by a following red candle. When you spot it, you can sell, as the sellers on the market have possibly managed to overpower the buyers and the price direction could reverse. Dark cloud cover. The dark cloud cover appears before the price drops down. A long green candle is followed by a red one that opens at a new high and closes below the middle of the green candle. Keep in mind that when trading currencies, a second candle opening at a new high is rare, so the red candle usually opens at the close level of the green one. Once you see this pattern, you can go ahead and sell, or you can wait for another, smaller red candle to form and confirm the dark cloud cover. Shooting star. The shooting star is a red candlestick with a small body, long upper shadow and a short lower one. When it appears at the end of an uptrend, it shows you that you can sell, since the price, which has been rising up to that point, may start falling instead. See? Reading Japanese candlestick charts is not rocket science.
Okay, now that was a general introduction to candlesticks, and we can get involved in all of the complicated patterns and all the different ways to look at it, from reading haramis to all types of bullish and bearish. We can look at 3 white soldiers, 3 black crows, morning and evening stars. I mean, there's a total of 32 general patterns, and of those, 16 are important patterns. But seeing those patterns is just the beginning. Now, what happens is, once you start seeing those, and I gave you the handout, so I'm not going to go through them step by step because you actually have them there, okay, is now once you've gone through the various candlestick patterns, either you're going to go start trading the battlefield with this newly acquired knowledge, which I don't advise you to, or you want to shout, "Stop it, I'm too confused with all these funny names and shapes and can't remember any of these things." Okay. That's one of the biggest problems. It takes a while to master candlesticks. It takes a while to be able to spot them and interpret them. Now remember, each candle of a candlestick chart is a reflection of the market sentiment. It is not just a standard patterns, but with keen observation, you can master the art of trading by looking at charts without even remembering the names of these patterns. Now, there are many ways to trade with Japanese candlesticks. Best is a combination with other indicators such as pivot points and support and resistance. You can trade only candlesticks, and I gave you some guidelines, but let's go see how we can add these to our charts without getting so confused and spending so much time and getting so lost. So let me pop up some live charts. There we go. Now, we live in a wonderful world of computers. And basically, candlesticks, or the rules of candlesticks, can be interpreted into computer language because they are defined. And you can find ways to have these automatically put on your charts. One of the ways we're looking at right now is on TradingView, and I'm going to go up here on the indicators, and I'm going to go into the scripts, and I'm going to come down here to where it says candlestick patterns identified, and I'm going to click on that, and lo and behold, look at my chart. I've got all those candlestick patterns that occurred during the day all identified. Now, granted, there's a lot of stuff on that chart that I couldn't even keep track of, too many things. But once you put these on a chart, you can go to Format, and lo and behold, we can then pick what type of candlestick patterns we want to be notified about, or which ones we think are worth trading. Like I don't trade hammers at all, so I can turn off the hammers. Okay, I don't trade shooting stars. I don't want to see them. I do like dojis. I don't use evening stars and morning stars for my own personal use. Okay, so I want bearish and bullish engulfing. I don't use piercing lines. Okay, I don't use bullish belt. I don't use bullish kicker. I don't use bearish kickers. So I can turn all those off. Hanging man and a dark cloud cup, don't use it, don't use. And then I can set up the colors where I want. Like you see, for doji, I just want a star. I don't need to see them. They happen so often. Okay. For bearish harami and bullish harami, I can decide where I want the name written, how I want it, what color I want it in, where I want it to appear, and then I just click OK. And that's all I'll get are the few candlesticks or the patterns I'm looking for. But it means I don't have to spend a lot of time. And regardless whether you're using TradingView charts or not, if I'm looking at gold right now, 1 hour, I see the charts tell me a bearish harami developed right here. It's going to hold true on whatever chart you're using, okay? Because it's not a subjective or determination. It's a set of rules, it's a pattern, it's an exact time that happened, and it happened. So you can see it here without tracking it down and then put it onto your charts wherever you're trading. That's one way you can use it. Or you can use the TradingView charts and pay for a subscription and get the better, faster charts. Or we can also come over here to investing.com and all we have to do is go over here and figure, let's pick a currency. Click on Forex. We're going to click on the Euro US dollar right over here. Okay. Now we have a standard chart right here. We're going to pick a 30-minute chart. And we're going to go up here to technical. And we're going to click under chart patterns, candlestick patterns. And look what it just did for us. Lo and behold, it's put our candlesticks right on here, and we can actually just go right over here, and wherever it says P for pattern, it tells it inverted hammer, bullish reversal. It's a reliability, exactly what time it occurred, what price it occurred, and we can scroll down here, and we can also see what has occurred in this asset in the Euro US dollar. We see 3 white soldiers, which is a very important candlestick pattern. It appeared in the half-hour chart, but it was 22 candles ago. So that was 22 candles a half hour is 15 hours ago. So it doesn't help us much. But we can customize it and decide what type of candlesticks we want to see, what time patterns we want to see, and what time of day, and then click on apply. And so anytime we come to the euro US dollar, it's going to give us a list down below of the current emerging patterns and completed patterns. Okay. What else do we need? Now, they also allow us to go a second way, which is my favorite. Just go up to the top menu bar, go under technical, go under candlestick patterns. And it will allow you to customize exactly what you want to see, the assets you want to track, okay, what type of signals, what time frame is important to you, because you don't need 1 day, 1 week, and 1 month if you're a short-term trader trading CFDs and Forex. Okay, I always want to see completed patterns because I want to see what if it just completed, but I'm more concerned with emerging patterns. That means if the pattern is just developed, it's a 2 candlestick pattern, it's the middle of developing, that's the ones that are important. We also have reliability. These are like the top tier and the second tier, I told you. I'm only concerned with the most important candlesticks, but I can take both levels if I want. And I pick the assets I want to track. I click on apply. And look at that. I don't have to spend any of my time looking for these. I just have to keep an eye right here. So we have in the Euro JPY, the 3 black crows. That's an ultimately important signal, is just emerging in a 1-hour chart. So that means it's just developing, and now what we can do is we can click right on the line here and open up the information bars and tell us this is a bearish reversal pattern. It's got a high reliability success. It's going to explain to you exactly what it means. Now, if we want, we can go over to the Euro JPY and pull it right up on our chart. And watch it develop. Here we have, you can see the 3 red crows developing right here. 3 red crows are 3 downward candles after an uptrend. Okay, and it's still developing because the last candlestick hasn't completed right here. But we have the 3 right, so down below, we have the 3 black crows in an emerging pattern. And we can see it right on the charts. And then you can either trade from these charts or transfer it over to your platform, wherever you're trading. But it means that we don't have to spend our time finding that we've got some type of computer that's doing the work for us. Now, there's many apps you can download right to your mobile device if you're trading on mobile. There's many you can search out that will give you reliable candlestick patterns. I tend to prefer the ones that are not associated with the platform because they're giving me straight data as opposed to platform biased signals. But like I said, there's all kinds of apps you can get for these. But it means that you can incorporate candlestick patterns and candlestick trading into your everyday applications without spending a huge amount of time tracking them down. It gives you more time to understand exactly how they're applied and what to do with them. So hopefully that gives you some good introduction to candlestick patterns and a good way to track them down. And hopefully you use the handouts I gave you that will explain it to you. Just download them now. Please click on the downloads and save them because like I said, there's no other way to get them. Okay, but I didn't invent these. They're available all over the internet. And this is not, Barry Norman's candlestick patterns. This is how candlesticks should be traded with no other interpretation. And use those for figuring out the best way to trade candlesticks and include them into your trading. If you'd like to learn more about candlesticks, if you go to www.alvexo.com and open a demo account, you can use all of their online education. They have ebooks for you, they have videos for you, and they'll also hook you up with a one-on-one financial analyst who will help explain it to you, on a one-to-one basis. So thank you very much. But add candlesticks into your everyday trading and find out. Don't trade them yet. See how they react. Use support and resistance lines with them. Use trend lines with them. See how they're acting. Make sure you use volume to help confirm what you're looking at. And you'll find in no time at all, they will be easily incorporated into your everyday trading as we do here. And the nice thing is about today's modern charts, you can switch from a bar chart right over to candlesticks by just clicking on them and changing, move back and forth, and incorporate them into your everyday decision-making capacity. So on that note, I'm going to say thank you very much for joining us and have a great week, and we'll see you on Thursday. Bye now.